Welcome to the deep dive. Today we're really getting into the engine room of businesses, how they run, how they manage danger, and how they plan for the future in a world that's, let's face it, pretty unpredictable.
That's right. And you might think it's all spreadsheets and, quarterly reports, but there's a fascinating interplay of strategy, risk, and human decisions going on.
Absolutely. Our mission today, to sort of cut through that complexity, we want to give you a real shortcut to understanding how organizations, big and small, for-profit or not, navigate all this,
Hmm.
how they create value, react to markets, and strategize.
And we've got a great stack of sources to draw from for this. Really comprehensive stuff covering enterprise risk, finance, economics, even major deals like mergers and acquisitions.
So it's a tree deep dive. We're covering the whole spectrum. Get ready to see the business world maybe a little differently after this.
So where do we start? I think the absolute foundation is this link between risk and value. Every single organization really exists to provide value for its stakeholders. That's its purpose.
Whether it's shareholders looking for profit or a community benefiting from a nonprofit services.
Exactly. But here's the thing that's often missed. Every single entity, no matter its goal, faces risks in trying to achieve that value. It's unavoidable.
Okay, so if risk is unavoidable, how do they even start to get a handle on it all? Is there like a standard playbook?
There is actually a really influential guide is the CSO Enterprise Risk Management Framework, ERM for short. It got a big update in 2017 and it's pretty comprehensive. It gives organizations a systematic way to think about and manage risk.
And how does CSO actually define risk? Is it just, bad things happening?
It's a bit more precise. Risk is the possibility that events will occur and affect the achievement of strategy and business objectives, so it's tied directly to goals.
Okay. And enterprise risk management itself.
ERM isn't just a checklist, it's the whole package. The culture, the capabilities, and the day-to-day practices that organizations use. And, crucially, it's integrated with setting strategy and measuring performance, all aimed at managing risk while you're trying to create, preserve, and ultimately realize value.
You keep mentioning value. It sounds like that's the absolute core here, isn't it?
It really is. For a for-profit company, value creation is often about balancing market opportunities against the risks to generate that profit. Makes sense.
But for nonprofits or government agencies.
For them, value looks different. It's more about delivering goods and services effectively to serve the community or the public good while still managing the risks that come with that mission. Still creating value, just a different kind.
And this value, it's not just static, right? I remember reading it goes through stages.
That's right. 4 key stages. First is creation. This happens when the benefits you generate actually outweigh the cost of the resources you used. Your people, money, tech, brand, all that.
Okay, so you've created something good. Then what?
Then comes preservation. This is about sustaining those benefits efficiently, keeping things running smoothly, maybe high customer satisfaction with profitable products, maintaining that value you've built.
But things can go wrong.
Definitely. That leads to erosion. If your strategy is flawed or your operations are just inefficient, value starts to decline. It eats away at what you've created.
And the final stage.
Realization. This is the payoff, when the stakeholders actually receive the benefits. That could be monetary, like dividends for shareholders, or non-monetary, like better public health from a government program.
It's interesting, though, you mentioned realization. It feels like sometimes companies create value, but struggle to actually realize it or capture it. Why is that final step sometimes tricky?
That's a great point. It often comes down to maybe poor communication of that value or not having clear metrics, especially for non-monetary benefits. Or sometimes the structures just aren't there to deliver it effectively to the stakeholders. A lot of focus goes on creation, less on the full life cycle.
Right, right. So this ERM framework, it recognizes that how an organization feels about risk, its risk attitude, really shapes its core identity, its mission, its vision for the future, and its fundamental core values.
Exactly. And getting those aligned is critical. If your mission says one thing, but your risk approach says another, you've got a problem.
And it's not a one-off thing, is it?
Yeah,
ERM is continuous.
absolutely. It's this ongoing interaction of the entity's culture, the sort of collective mindset about risk its capabilities, like its ability to adapt and compete, and its actual practices, the methods used to manage risk. You often hear that culture starts at the top, and it's so true. Those core values deeply influence daily risk decisions.
Yeah, and if the culture doesn't match the stated values or the risk appetite, that's a recipe for trouble, strategically.
It really impedes strategy,
Really?
which brings us to integration with strategy setting. Strategy needs to align with the mission and vision, right? And business objectives flow from that strategy.
So how does ERM fit in there?
ERM helps the organization understand how risk affects everything it does, promoting decisions that are consistent with its overall risk attitude. Think of mission and vision setting the stage, and ERM ensuring the performance aligns with the script, so to speak.
That makes sense. Now, when we talk about managing risk linked to value, the goal isn't zero risk, is it? That's impossible.
Exactly. ERM aims for a reasonable expectation, not absolute certainty that objectives will be met within the organization's risk appetite.
Okay, risk appetite. That sounds important. What exactly is it? Is it like a speed limit for risk?
It's more like a range, actually. Risk appetite is the types and amount of risk an organization is willing to accept to achieve its value goals. It's not one specific number. And it's flexible. It can vary across different products or business units or change over time.
And it often shows up first in the mission and vision statements.
Often, yes. It's implicitly there. And managing risk within that appetite is what really helps an organization successfully create, preserve, and realize value. It's about informed risk-taking, not just avoidance.
It sounds incredibly interconnected. And the framework itself has what, 5 core components?
Yes, 5 interrelated components, all driving towards enhancing value. They are governance and culture, strategy and objective setting, performance, review and revision, and the ongoing information, communication, and reporting. Think of it like an ecosystem.
Okay, let's break those down a bit. Governance and culture, that's the foundation.
Absolutely. It's about the tone at the top, strong board oversight, the O in the Doves acronym. Some people use commitment to core values, getting the right people, and setting up the operating structure. This really shapes how risk is viewed, from risk-averse to risk-aggressive.
Got it. Then strategy and objective setting, or SR, this is where RM meets the plan.
Precisely. You evaluate different strategies, check they align with the mission and vision, and understand their risk profiles. You set clear business objectives, specific, measurable, achievable, relevant, that also align with your risk appetite, like a lender setting interest rates based on perceived default risk versus their return objective.
Right. Next is performance, the doing part. VPR.
Yes. This is where you identify, assess, prioritize, and respond to risks. You develop a portfolio view, entity-wide. You look at risk severity, impact, and likelihood. And you distinguish between inherent risk, target residual risk, and actual residual risk. Basically, risk before action, risk you want after action, and risk you actually have left.
And then you decide how to respond. What are the options there?
The main ones are accept the risk if it's within your appetite. Avoid it, maybe by getting out of a certain business line. Pursue it, actually take on more risk if the potential reward is high enough. Reduce it using controls. Or share it, like through insurance or outsourcing. It's a whole toolkit.
Which of those do you think is the hardest for companies to actually execute well? Pursuing risks seems counterintuitive sometimes.
That's often the trickiest, I agree. Perceive requires a really mature understanding of risk and reward and a culture that's comfortable with calculated bets for growth. It's easy to just focus on reducing or avoiding. Seeing risk as opportunity takes discipline.
Okay, after performance comes review and revision, or SRR, keeping things up to date.
Exactly. The business world changes constantly, so you need to continuously evaluate your strategies and objectives. Are there substantial internal changes, like innovation, or external ones, like new regulations? You're always looking to improve the ERM process itself, reviewing risk and performance regularly.
And the last one, running through everything, is information, communication, and reporting to P.
Yes, this is the continuous flow. Getting the right information, using tech effectively, communicating risk insights internally and externally, and reporting on how risk, culture, and performance all connect. Keeps everyone on the same page.
So when a company gets this right, when ERM is really embedded, what are the big payoffs?
Well, you significantly increase your range of opportunities because you understand the risks better. You boost positive outcomes and reduce those nasty surprises. You get a much better handle on entity-wide risk, seeing the big picture.
And it probably helps smooth that performance, right?
Yeah.
Less volatility.
Definitely. Reduces performance variability, and it helps you use your resources much more effectively. It's basically a system for smarter, more resilient growth, better decisions, faster.
Okay, that's a fantastic overview of the big picture with ERM. Now, let's zoom in a bit on the nitty-gritty of financial risk, because that's where a lot of this hits the bottom line, isn't it?
Absolutely. And the core concept in finance is this constant risk and return trade-off. Generally speaking, the more risk you take on, the higher the potential return you'd expect to get. Investors demand compensation for uncertainty.
But not everyone feels the same way about risk, right? Managers have different attitudes.
That's true. You have risk in different managers. They wouldn't demand a higher return even if risk goes up. Pretty rare. Then the most common type, risk-averse managers. They need higher expected returns to justify taking on more risk. Standard approach.
And the opposite.
The risk-seeking manager. They might actually accept lower expected returns as risk increases. Maybe they're chasing a long shot or just enjoy the thrill. Also less common in most corporate settings.
Okay, let's break down some specific types of financial risk. First, interest rate risk.
Yeah, also called yield risk. This is simply the risk that the value of an investment, like a bond, will go up or down because market interest rates change. If rates rise, existing bonds with lower rates become less valuable.
Then there's market risk, the unavoidable one.
That's the one, also called systematic or non-diversifiable risk. This is tied to the overall economy, things like war, inflation, recessions, political shocks. You can't diversify this away because it affects almost everything.
But you can diversify away unsystematic risk.
Exactly. That's the firm-specific or diversifiable kind. It comes from random causes unique to a company or industry, like a strike, a lawsuit, a product failure. Good portfolio diversification can significantly reduce or even eliminate this type. Just remember DUNS. Diversifiable is unsystematic, non-diversifiable is systematic.
Handy mnemonic. What about credit risk?
That affects borrowers. It's the risk they won't be able to get financing, or only on bad terms because their creditworthiness is poor.
And the flip side for lenders is default risk.
Precisely. The risk that the borrowers simply won't pay back the principal or interest they owe. A major concern for banks and bondholders.
Okay, two more. Liquidity risk.
This hits investors or lenders. It's the risk you might not be able to sell an asset quickly without having to slash the price significantly. Think trying to sell a very niche, thinly traded stock.
And price risk.
This is the risk that the value of a specific security or portfolio will decline. It's often related to those diversifiable, unsystematic factors we talked about.
So all these risks connect back to the return someone expects. And return is usually measured by interest rates. But there are different kinds of rates, aren't there? It's not always straightforward.
Not at all. You have the basic stated interest rate, the advertised nominal rate. Simple enough.
But then things get complicated with fees and stuff.
Right. The effective interest rate is the actual cost of borrowing after you factor in fees and charges. Like that example. Borrowing $10,000 at 10%, but paying $125 fees, you only get $9,875, but still pay $1,000 interest. Your effective rate is actually over 10% because you paid the interest on less cash received. That's the real cost.
Okay, and APR, annual percentage rate.
APR takes that effective periodic rate and multiplies it by the number of periods in a year. So for that loan example, if the periodic rate was 4.05% semi-annually, the APR is 8.10%. It helps compare loans, but crucially, it doesn't account for compounding within the year.
So for compounding, we need the effective annual percentage rate, or effective APR.
Exactly. That takes the stated rate and adjusts it for how often interest compounds. An 8% stated rate compounded semi-annually actually gives you an 8.16% return over the full year. That's the true annual yield or cost.
Good distinction. And quickly, simple versus compound interest.
Simple interest is just calculated on the original principal amount. Easy, but less powerful. Compound interest is calculated on the principal plus any accumulated unpaid interest. So your interest starts earning interest. That's where wealth really grows over time. The difference can be huge.
So, given all that, how do investors figure out the minimum return they need for taking on these risks?
That's the required rate of return. It starts with a theoretical risk-free rate, what you could get on a super safe investment like a government bond. Then you add various risk premiums on top.
Premiums for what specifically?
There's a maturity risk premium for the uncertainty of longer-term investments, a purchasing power risk premium, basically an inflation premium, to compensate for money losing value, a liquidity risk premium if it's hard to sell, and a default risk premium for the chance the borrower won't pay back. You stack these up on the risk-free rate to get the total required return.
Makes sense. Each risk gets its own compensation. So how do businesses actually manage all this financial risk?
Well, the big one we already mentioned is diversification. Spreading your investments across different assets or activities whose risks aren't perfectly correlated. It's incredibly effective at reducing or eliminating that unsystematic, firm-specific risk. Don't put all your eggs in one basket, basically.
Classic advice. But what about specific risks, like interest rate risk?
For interest rate risk, companies might use floating rate debt instead of fixed, so their payments adjust. Or they can use derivatives financial instruments like forward rate agreements, FRAs, or interest rate swaps designed to gain value if rates move against their underlying position. It's like insurance against rate hikes.
And market risk, the tough one.
Yeah, you can't diversify market risk away, but you can try to hedge it.
Yeah.
Maybe using derivatives that increase in value when the overall market falls, or short selling. Like that Dylan Bank example, the CFO shorts S&P 500 index funds anticipating an oil price drop, hurting the economy. If the market falls, the short position profits, offsetting other losses. Risky, though, because if the market goes up, they lose on the short.
Right. And unsystematic risk.
Back to diversification. That's the primary tool there.
What about credit risk? If the company wants better loan terms.
They need to manage their credit risk by improving their credit rating, pay bills on time, manage debt levels, demonstrate financial stability. That makes lenders more willing to offer favorable terms.
And from the lender side, managing default risk.
Lenders manage default risk primarily by deciding who to lend to. They can stick to low-risk borrowers, or they can lend to higher-risk ones, but charge them a higher interest rate to compensate for that increased risk. It's a trade-off.
Liquidity risk. How do you manage not being able to sell quickly?
Mitigate liquidity risk mainly by investing in assets traded in active deep markets. Things like major stocks or government bonds are usually much easier to sell quickly without a big price drop compared to, say, private equity or obscure collectibles.
And finally, price risk. The risk a specific stock price falls.
Price risk again relates heavily to diversification, but you can also use short selling if you anticipate a decline, or buy put options, which give you the right to sell an asset at a predetermined price, protecting you from drops below that level.
Okay, that covers a lot of domestic financial risk. But things get even more complex when companies operate internationally, right?
Yeah.
Especially with currency exchange rate risk or FX risk.
Oh, absolutely. FX risk is huge because currency values are constantly shifting against each other, and that volatility can hammer profits or create unexpected windfalls.
What drives those shifts?
It's a mix of factors. On the trade-related side, you've got relative inflation rates. If inflation is higher in the U.S. than Mexico, the dollar might weaken against the peso as people seek to maintain purchasing power.
Income levels matter too.
Yes, relative income levels. If U.S. incomes rise sharply, Americans might travel more to Mexico, demanding more pesos, potentially strengthening the peso. And government controls like tariffs or import restrictions can directly impact currency demand and thus exchange rates.
What about the financial side? Money flowing across borders.
Huge factor. Relative interest rates and capital flows. If Mexico offers much higher interest rates on investments than the U.S., capital might flow into Mexico, increasing demand for pesos and strengthening the currency. It's all supply and demand, driven by these trade and financial forces.
And this FX risk shows up in different ways for companies, doesn't it? 3 types of exposure.
That's right. First is transaction exposure. This is the simplest the gain or loss on a specific individual transaction due to currency fluctuations between when the deal is made and when payment occurs. Like that Seattle import-export example with Canadian dollar receivables, if the C2 weakens before they get paid, they receive fewer U.S. dollars. Direct hit.
Okay, transaction exposure is clear. What's economic exposure?
Economic exposure is much broader. It's the risk that the company's overall future cash flows could be positively or negatively impacted by currency swings. Think about currency appreciation. If the U.S. dollar strengthens, U.S. exports become more expensive abroad, potentially hurting sales volume, while imports become cheaper. It affects the whole business model.
Like Pete's Piñatas making goods in Mexico, peso costs, but selling in the U.S., dollar revenues. If the peso strengthens a lot,
their costs in dollar terms shoot up, potentially wiping out their profit margins, even if sales volume stays the same. That's economic exposure. It hits the fundamental economics of the business.
And the third type, translation exposure.
Translation exposure arises when a company consolidates the financial statements of its foreign subsidiaries into its home currency for reporting purposes. The value of foreign assets, liabilities, equity, and income can change on the parent company's books simply because the exchange rate moved, even if the underlying foreign operation did fine in its local currency.
So this affects companies with lots of foreign operations more.
Much more. The more significant your foreign subsidiaries are relative to the whole company, and the more volatile the currencies they operate in, the greater your translation exposure. It's mainly an accounting issue, but it can affect reported earnings and investor perceptions.
Okay, so companies face these different exposures. How do they manage transaction exposure, the risk on specific deals?
A key strategy is selective hedging, basically using financial instruments to lock in an exchange rate for a future transaction, reducing the uncertainty. Like worldwide sweet peaches buying pesos forward because they owe a supplier and fear the peso strengthening.
What kinds of instruments do they use?
Several common ones. A futures hedge uses standardized contracts traded on an exchange, good for smaller, common amounts and timeframes. Worldwide sweet peaches could buy peso futures to lock in a purchase price. Running apparel, expecting yen, could sell yen futures to lock in a selling price.
Futures are standardized. What if you need a custom amount or date?
Then you might use a forward hedge. These are similar, but are customized contracts negotiated directly with a bank, more flexible for larger, specific needs. Works the same way, lock in a future rate for payables or receivables.
Okay, futures and forwards. What about a money market hedge? That sounds different.
It is a bit more complex. For a payable, money you owe in foreign currency, you essentially use your home currency today to buy the foreign currency at the current spot rate, then invest that foreign currency so it matures right when your payable is due. You lock in today's rate and eliminate future FX risk.
So Duffy's Discount Piñatas owes pesos in 90 days. They could buy pesos now.
Right, buy the pesos now, maybe borrowing dollars to do it, invest those pesos in Mexico for 90 days, and then use the maturing investment to pay the supplier. For a receivable, money owed to you, it's like taking out a loan in the foreign currency today, converting it immediately to your home currency, and then using the incoming receivable later to pay off that foreign currency loan. Again, locks in today's rate.
Clever, but definitely more involved.
Yeah.
What about options?
Currency option hedges offer flexibility. You buy the right, but not the obligation, to buy or sell currency at a set price, the strike price, on or before a certain date.
So call option is for payables, buying the right to buy.
Exactly. If you need to buy pesos, you buy a call option. If the market price, spot rate, goes above your strike price when payment is due, you exercise the option and buy at the cheaper strike price. If the spot rate is lower, you just let the option expire and buy in the market. You only lose the premium you paid for the option.
And a put option is for receivables, buying the right to sell.
Correct. If you're receiving pesos, you buy a put option. If the spot rate falls below your strike price, you exercise the option and sell at the higher strike price. If the spot rate is higher, you let the option expire and sell at the better market rate. Again, your maximum loss is the premium paid. It provides downside protection while keeping upside potential.
But that premium is a cost, right? It eats into the savings if you exercise.
It does. It's a sunk cost you pay for the flexibility and protection. You have to factor that into the net benefit.
What about very long-term currency risks, years out?
For those, companies might use long-term forward contracts if available, or perhaps currency swaps. A swap involves two parties agreeing to exchange streams of payments in different currencies over a long period, often based on fixed or floating interest rates, effectively locking in exchange rates for years.
Are there other, maybe simpler techniques?
Sure, things like leading and lagging, adjusting the timing of payments between subsidiaries to catch favorable rates. Cross-hedging, where you hedge risk in one currency using a related, more liquid currency's derivative if a direct hedge isn't practical. And the simplest, maybe, is currency diversification, just holding assets and liabilities in multiple currencies to spread the risk.
Now, what about mitigating the broader economic and translation exposures? Can you hedge those with simple financial instruments?
Not usually, not easily. Economic exposure is about the fundamental business model. Mitigating it often requires deeper strategic changes, like shifting production locations, changing sourcing strategies, or adjusting your sales mix across different currency regions, much harder than hedging a single transaction.
And translation exposure, the accounting one.
Translation exposure is typically managed through entity-wide strategies, maybe balance sheet hedging, where you try to match foreign currency assets with foreign currency liabilities, or through specific accounting and reporting choices. Less about day-to-day financial hedges.
Fascinating stuff. Okay, let's shift gears now and look at the broader market dynamics that influence all these strategic decisions. Back to basics, maybe, with supply and demand. We're talking microeconomics here, right? Individual markets.
Exactly. Microeconomics looks at the behavior of individual consumers, households, and firms, rather than the whole economy like macroeconomics does. And yes, supply and demand are the absolute bedrock.
Let's start with demand. The demand curve shows how much people want at different prices.
Precisely. It shows the maximum quantity consumers are willing and able to buy at each specific price. And quantity demanded is just that specific amount at one particular price point on the curve.
And this is where people get mixed up sometimes, right? The difference between moving along the curve and shifting the whole curve.
Huge distinction. A change in quantity demanded is only caused by a change in the product's own price. It's a movement along the existing demand curve. But a change in demand is a fundamental shift of the entire curve, left or right. This is caused by factors other than the current price.
And the basic law, price goes up, demand goes.
Down. The fundamental law of demand is an inverse relationship. Price up, quantity demanded down. Price down, quantity demanded up.
Why is that?
Two main reasons. The substitution effect. If Pepsi gets cheaper relative to Coke, people buy more Pepsi instead of Coke. And the income effect. If a price falls, your purchasing power effectively increases, so you can afford to buy more of that good, and maybe others too. Your real income goes up.
Okay, so what shifts the whole demand curve then? Not price, but
Lots of things. Changes in wealth, people feel richer, demand for normal goods goes up. Price of related goods, if a substitute gets cheaper, demand for your good falls. If a complement gets cheaper, like printers and ink, demand for your good might rise.
what else? Income, tastes.
Yep, consumer income changes. More income generally means more demand for most goods. Consumer tastes or preferences shift. Suddenly, everyone wants avocado toast. Demand shifts right. Consumer expectations about future prices or availability expect a shortage. Demand might spike now. And the number of buyers in the market, more potential customers, more demand.
Got it. Now let's flip to supply. The supply curve shows how much producers are willing to sell.
Right. The maximum quantity sellers are willing and able to produce and offer at each price. And quantity supplied is the specific amount at one price on that curve.
And same distinction applies. Moving along the curve versus shifting the curve.
Exactly the same. A change in quantity supplied is a movement along the curve, only caused by a change in the product's own price. A change in supply is a shift of the entire curve, caused by factors other than the current price.
In the law of supply, price goes up, supply goes.
Up. The fundamental law of supply is a positive relationship. Higher prices generally give producers more incentive to produce and sell more because it's potentially more profitable.
So what shifts the whole supply curve?
Key factors include price expectations of the supplying firm. If they expect prices to rise later, they might hold back supply now. Production costs, lower costs like wages or raw materials, make it profitable to supply more at any given price, shifting supply right.
Technology must be a big one too.
Huge. Changes in production technology, better tech, usually lowers costs and increases output, shifting supply right. Also, price or demand for other goods the firm could produce. If the price of corn goes way up, a farmer might shift land from soybeans to corn, reducing soybean supply. And subsidies encourage supply, taxes discourage it.
Okay, so we have demand and supply curves. Where they meet is
Market equilibrium. That's the sweet spot. The price where quantity demanded exactly equals quantity supplied. The market clears no shortage, no surplus, no pressure for the price to change, all else being equal.
what if the price isn't at equilibrium? Too low.
Price too low means quantity demanded is greater than quantity supplied, you get a shortage. Buyers want more than sellers are offering at that price. Think empty shelves.
And if the price is too high?
Price too high means quantity supplied exceeds quantity demanded a surplus. Sellers have piles of unsold goods. Think post-holiday sales.
And governments sometimes step in here, right? Price controls.
They do. A price ceiling sets a maximum legal price, usually below equilibrium. Think rent control. It aims to make things affordable, but often leads to shortages because suppliers have less incentive and demand is high.
And a price floor.
A price floor sets a minimum legal price, usually above equilibrium. Think minimum wage for labor. It aims to support producers or workers, but often leads to surpluses like unemployment, in the case of minimum wage if it's set above the market clearing wage. Always a trade-off between social goals and market outcomes.
Now let's talk elasticity. How responsive are supply and demand to price changes?
Exactly. Elasticity measures that sensitivity. Price elasticity of demand is the percentage change in quantity demanded divided by the percentage change in price. We usually look at the absolute value.
And what do the numbers mean? Less than 1.
If the absolute value is less than 1.0, demand is inelastic. Quantity demanded doesn't change much when price changes. Think gasoline, maybe, or life-saving drugs. People buy them even if the price goes up. Few substitutes, often essential.
Greater than 1.
Demand is elastic. Quantity demanded is very sensitive to price changes. Lots of substitutes usually available, or it's a luxury good, or consumers have time to adjust. Think specific brands of soda.
And equal to 1.
Unit elastic. Quantity changes proportionally to price.
Why does this matter for businesses?
Crucially impacts total revenue. If demand is inelastic, raising the price increases total revenue. Price goes up more than quantity falls. If demand is elastic, raising the price decreases total revenue. Quantity falls more than price goes up. Knowing your elasticity is vital for pricing strategy.
And price elasticity of supply. Similar idea.
Similar idea, measuring how much quantity supplied responds to price changes. Factors like how easily goods can be stored or how quickly production can be ramped up affect supply elasticity. Easier storage or faster production means more elastic supply.
Okay, two other elasticities. Cross elasticity.
Cross-elasticity of demand measures how the quantity demanded of one good changes when the price of another good changes.
What do the results tell us? Positive, negative?
If it's positive, the goods are substitutes. Price of Coke goes up, demand for Pepsi goes up. If it's negative, they're complements. Price of printers goes up, demand for ink cartridges might fall. If it's zero, they're unrelated.
And income elasticity.
Income elasticity of demand measures how quantity demanded changes as consumer income changes. Positive means it's a normal good buy more as income rises, like vacations. Negative means it's an inferior good buy less as income rises. Maybe switch from generic brands to premium.
Very useful concepts.
No.
Now, shifting slightly, let's talk about inflation. That sustained rise in prices. How does it affect businesses?
Inflation impacts businesses in many ways. First, it erodes the purchasing power of money. So holding monetary assets like cash becomes less attractive. But interestingly, if you have fixed-rate monetary liabilities like long-term debt, inflation can help you because you repaid a loan with dollars that are worth less.
What about investments?
Inflation eats away at the real return on fixed-rate debt, like bonds. Its effect on stocks is more complex. Rising costs can hurt profits, but sometimes companies can pass those costs on. Alternative investments like real estate, commodities, maybe tips, treasury, inflation-protected securities are often seen as better hedges against inflation.
And debt we mentioned. Future expenses.
Rising input costs due to inflation, wages, materials squeeze profit margins unless businesses can raise their own sales prices. That ability to pass on costs is key during inflationary times.
Okay, so bringing all these market forces together, how do companies build their actual strategy? A common tool is SWOT analysis, right?
Absolutely. SWOT, strengths, weaknesses, opportunities, threats is fundamental. Strengths and weaknesses are internal factors the company can largely control. Things like its innovative capacity, management skill, core competencies, brand reputation, internal communication effectiveness.
And opportunities and threats, external.
Yes, opportunities and threats are external, things happening in the wider environment. Broad factors like the economy, regulations, technology shifts, social trends, and more industry-specific factors like barriers to entry, competitor actions, substitute products, and the power of your buyers and suppliers.
Like that diverse company example, strength in international ties, weakness in aging equipment, opportunity in healthcare demand, threat from compliance costs. It paints a picture.
Exactly. It helps organize thinking about the internal situation and the external landscape.
Another really powerful framework for analyzing that external landscape, especially competition, is Porter's 5 forces. This gets really interesting.
Michael Porter's framework is classic. It looks at the forces that determine industry profitability. First is barriers to entry. How easy is it for new competitors to jump into your market? High barriers like patents, huge capital needs, strong brands, economies of scale protect existing firms. Low barriers invite competition.
Second force.
Market competitiveness, or the intensity of rivalry among existing players. It gets fierce when there are many competitors, growth is slow, products aren't differentiated, or exit costs are high, trapping companies in the market, lots of advertising wars, price cuts, R&D battles.
Third, substitutes.
Existence of substitute products.
Yeah.
Not direct competitors, but alternatives that meet the same customer need. Think trains versus planes or coffee versus tea. If substitutes are readily available, perform well, and have low switching costs for customers, they put a cap on the prices your industry can charge.
Fourth force. Buyer power.
Bargaining power of the customers. How much leverage do buyers have to demand lower prices or better quality? Their power is high if they buy in large volumes, if the product is undifferentiated, if they have lots of information, if switching suppliers is easy, or if they can credibly threaten to make the product themselves. Backward integration.
And the final force? Supplier power.
Bargaining power of the suppliers. Can your suppliers dictate terms or raise input prices? Their power is high if there are few suppliers, if their product is critical and differentiated, if switching suppliers is costly for you, or if they can threaten to enter your business. Forward integration.
Understanding these five forces helps a company figure out where it stands competitively and how attractive an industry is.
Precisely. It informs strategy, and that strategy aims to build a sustainable competitive advantage, offering value to customers that exceeds the cost of creating that value.
Two basic forms of advantage: cost and differentiation.
That's right. Cost leadership advantage means being the lowest cost producer and seller in the industry. Allows you to either undercut rivals on price or match prices and earn higher margins. Differentiation advantage means making your product or service unique and perceived as superior by customers, allowing you to command a premium price.
So how do these translate into actual strategies?
Well, the most straightforward is cost leadership. Be the cheapest. Like toys-only companies selling online with minimal overhead. Works best when buyers are price sensitive and the product is standardized. Fails if cost-cutting hurts quality too much or if rivals can easily copy your cost savings.
Then differentiation. Be unique, like quality bathroom ink with high-end tubs. Works when customers value that uniqueness and are willing to pay more. Fails if the uniqueness isn't actually valued or if it costs too much to create relative to the price premium you can get. Can you combine them?
That's the aim of a best cost strategy. Provide high perceived value or quality, but at a lower price than pure differentiators. Think Walmart leveraging scale for low prices, but offering a huge selection and decent quality. Tricky to pull off risk of being stuck in the middle, not cheap enough or differentiated enough.
And the last one, focus.
Focus niche strategies target a narrow segment of the market, serving their specific needs exceptionally well, using either cost leadership within that niche or differentiation within that niche, like all-star baseball gloves focusing only on pro and college players. Works if the niche is big enough and underserved. Fails if the niche shrinks, or if broad competitors successfully target it.
Okay, that's a great look at strategy within a market, but many companies look beyond their home borders. Why do they decide to go international in the first place? It seems like a lot of hassle.
It can be, but there are powerful motivations. One is comparative advantage. Countries, like companies, are better off specializing in what they produce most efficiently and trading for the rest. Bermuda, specializing in tourism to pay for imported cars and fuel, is a perfect example. It maximizes global resources.
What else drives them abroad?
Imperfect markets. Sometimes resources or factors of production can't move freely across borders due to regulations or just practical limitations. This encourages companies to go directly to where the resources are or where the opportunities lie that they can't access purely through domestic trade, like high-tech components sourcing vital parts from Asia and Europe.
And the product cycle.
Right. The product cycle theory suggests a natural progression. A company innovates and succeeds domestically. Competition grows at home. To keep growing, they start exporting. Then, as foreign markets mature and foreign competitors emerge, they might set up production abroad to stay competitive locally. It's an evolutionary path for many products and firms.
So once they decide to go international, how do they actually do it? What are the methods?
There's a whole spectrum. The simplest is just international trade, exporting goods made at home or importing goods made abroad. Low commitment, low risk initially.
What's next up the ladder?
Licensing. You grant a foreign company the right to use your technology, process, or brand name in their market in return for a fee or royalty, like Wireless Inc., letting a Mexican firm use its cellular system tech.
And franchising, like fast food chains.
Exactly. Franchising is similar, but usually involves providing a more complete business model, marketing, operating procedures, training in return for fees, flip-a-burger training operators in Peru.
More involved options.
Joint ventures. Teaming up with a local partner in the foreign market. You share ownership, risk, and potentially expertise. Like Engulf and Devour partnering with a French firm for distribution. Can be good for navigating local complexities.
And the biggest commitment.
Direct foreign investment, DFI. This means actually buying or establishing your own subsidiary or operations in the foreign country. Highest risk, highest control. And then there's global sourcing, which is really about integrating your entire value chain, R&D, production, marketing across multiple countries to optimize efficiency on a global scale.
But going global isn't just about choosing a method. There are tons of extra factors and risks compared to operating domestically, right? Politics, legal systems.
Huge ones. Political and legal influences are critical. You face political risks, instability, policy changes, different legal requirements, the scary prospect of asset expropriation by a foreign government, different tax regimes, tariffs, though. Companies use things like transfer pricing between subsidiaries to try and manage tax burdens, limits on foreign ownership, rules about local content. It's complex.
What about the economic systems themselves?
very different economic systems. Centrally planned economies versus market economies. And you see unique structures like the Japanese keiretsu or Korean cable, big interconnected groups of companies that finance, produce, and supply each other. You have to understand the local economic context.
And culture? That must be a minefield.
Culture is massive and often underestimated. Differences in values, attitudes, communication styles, individualism versus collectivism, uncertainty avoidance, long-term versus short-term thinking, views on hierarchy. These impact everything from negotiations to employee management to marketing.
Technology levels can differ too. Infrastructure.
Absolutely. Technology and infrastructure gaps can be significant. Differences in communication networks, transportation quality, reliable power and water, the skill level of the local workforce, even basic accounting practices. You might have to build what you take for granted at home.
And beyond the FX risk we already covered, what are other inherent risks of international business?
You face risks related to foreign economies. How healthy is that economy? Is foreign demand strong or weakening? What are local interest rates doing? High inflation eroding purchasing power. How is the local currency performing against others? All impact your results.
And political risk again, beyond just laws.
Yes, political risk in a broader sense, non-economic events. Expropriation is the extreme, but also things like excessive bureaucracy, corruption, negative government or consumer attitudes towards foreign firms, currency controls making it hard to get profits out, inconvertibility, civil unrest, or even war. Huge potential disruptions.
Okay, so that covers the global landscape. Let's wrap up by looking at the economic effects of really significant transactions when companies combine or break apart. Business combinations first.
Right. Business combinations happen for very strategic reasons. Four main types. First, horizontal. Companies in the same industry doing the same thing merge. Heinz and Kraft Foods. Goal: reduce competition and gain market share, economies of scale.
Second, vertical.
Vertical combination. Companies at different stages of the same production process or value chain combine. Time Warner, content creation distribution, and Turner Broadcasting, cable channels, can be backward integration, securing suppliers, or forward integration, securing customers' distribution.
Circular. That sounds odd.
Circular combination. Companies with relatively unrelated businesses join up, often because they can share resources like distribution channels, marketing, or maybe management expertise. Pharma Inc. Buying a residential real estate firm focused on adult communities, maybe cross-selling opportunities or shared overheads, often about administrative cost savings.
And diagonal.
Diagonal combination. A company combines with another that provides necessary support services for its main activity. Land-Bright Farms, livestock, merging with fresh meats, transportation, ensures reliable support for the core business.
How do these deals actually happen? The mechanics.
Different ways. A merger creates a single new legal entity from two or more existing ones. Dell and EMC becoming Dell Technologies. A plus B equals C.
An acquisition.
In an acquisition, one company, the acquirer, takes over another, the target, and the acquirer remains as the legal entity. A plus B equals A. Like AT&T reacquiring Bell South.
Tender offer.
A tender offer is when the acquiring company bypasses management and makes an offer directly to the target company's shareholders to buy their shares at a specific price. Hostile takeovers often use this.
And purchase of assets?
Purchase of assets. The acquirer buys specific assets, maybe a division, buildings, equipment, rather than the entire company's stock. The selling company might continue to exist, or it might liquidate after selling its assets.
Okay, that's combining. What about the opposite? Breaking up? Divestiture?
Divestiture is disposing of a component or business unit. Several ways to do this, too.
Like a sell-off.
A sell-off is straightforward. Outright sale of a subsidiary or division to another company. Maybe it no longer fits strategically, or the parent needs cash. Becco selling Blended Ltd.
Spin-off. That creates a new company.
Yes, a spin-off creates a new, independent company from a subsidiary or division. Shares of the new company are distributed to the parent company's existing shareholders. The idea is the unit might be worth more on its own. Eli Lilly spinning off Guidant is a famous example.
An equity carve-out.
An equity carve-out is when the parent company sells a portion of its ownership in a subsidiary to the public through an IPO, initial public offering. The parent gets cash from the sale, but importantly, it typically retains a controlling interest in the newly public subsidiary. It raises capital while keeping strategic control, like Tico Industries doing this to get cash but still guide the unit.
Wow. We have covered an incredible amount of ground today.
Right.
From the core ideas of risk and value in ERM,
Through the weeds of financial risk, interest rates, hedging, all the way to market forces like supply, demand, elasticity, competition.
And then expanding out to global business challenges and motivations, and finally, these major strategic transactions like mergers and spin-offs.
Mhm.
It really shows how interconnected everything is.
It absolutely does. Hopefully, this deep dive has given you a powerful shortcut, a framework for understanding how all these pieces fit together in the complex world of business. Lots of practical examples in there, too.
Definitely. So, to leave everyone with something to chew on,
Mm-hmm.
considering everything we've discussed, the constant change, the global markets, the emerging risks,
Mm-hmm.
what do you think is the single most critical capability for any organization that wants to not just survive, but actually sustain and grow its value over, say, the next decade?
Single most critical capability. That's tough. But if I had to pick one, I'd probably say adaptability. Or maybe agility. It's not just about reacting to change anymore. It's about anticipating it, being flexible enough to pivot quickly, and constantly learning and reconfiguring.
Yeah.
The ability to learn, unlearn, and relearn faster than the environment changes might be the key differentiator.
Adaptability and agility. A great thought to end on. Thank you so much for joining us on this deep dive.
My pleasure. Until next time.